Hello, this is Paul with OUTPACEsys, and this is your report for the week ending on the 7th of November 2008. As you may recall from last week's comment, we expected some level of counter-trend from the sharp lows the market had reached recently, but the long-term trend is still quite bearish. This situation implies higher than usual volatility in the market, so this week we continued to focus on very short-term trades, following the relatively fast motions typical of these uncertain days. We actually had only two signals this week. On Monday, we opened a long position, which we closed the following day, a few short hours before the market started the long drop. This is shown in this chart, where you see the opening trigger here and the time when we closed. As you can see, there was a sharp fall just after that. We caught the down move in a trade we opened the following day, as shown in this chart. Don't be confused by this chart going up. This is the chart representing a put option that we traded, and so it's going up because the market is indeed going down. The results are in this table, which reports the individual trades with their opening and closing times and the price per contract at open and close for each trade. As usual, we also report what a $2,000 investment for each trade will have evolved to. This shows you what you could do with the $2,000 amount utilized on each trade. We're not compounding or reinvesting, we just buy the number of contracts allowed by the opening and option price. In the first trade, each contract cost $370, so our $2,000 capital bought 5 contracts. In the second trade, opening price was $86 per contract, and so we bought 23 of them. Once again, the results were outstanding. One trade producing a nice 10% profit, followed by a trade that more than doubled the capital at risk. A truly exciting week. The initial $2,000 grew to $4,306. This is a profit of 115% over the initial margin. Looking at market trends, the Nasdaq, as we said, had another negative week and remains in its very bearish long-term stance. So we expect some more of this erratic behavior in the days to come. The trading triggers we looked at this week are reported on this hourly scale as it pertains to the Qs. The S&P 500 once again shows the same trend as the other indexes. This chart reports our daily triggers. Crude oil continues in its incredible volatility, and after a sharp counter trend early in the week, it closed the week lower once again. These are the daily signals we had this week. Gold had a very bouncy behavior also, and we are still definitely bearish, as it shows in this chart with our triggers. Bonds continue their bold recovery, but are still in a bearish long-term mode. Let us look at performance comparison charts. This is the 3-month performance comparisons for the Nasdaq, the Dow Jones, and the S&P 500, followed by the year-to-date performance chart, which still shows a 35% loss on the average for the 3 equity indices. This is the year-to-date performance chart for the country ETFs that we are following, which show a similar bearish mode for these countries also. The year-to-date performance of key markets, including key commodities such as crude oil, gold, besides the S&P and the bonds, are shown in this chart, where the winner year-to-date are still the bonds, with a performance close to 0% change. Come visit us at outpaces.com to read this report at leisure. We'll see you next week. Happy trading!